Hey, good morning. There's people still joining us, so we'll give them a minute or two before we start our session. Good. We'll start now. Good morning. Welcome to our annual not-for-profit accounting update. I'm Mike Santicho, partner in the Great Lakes region, and we think we have a very informative session for you. Just a little bit about our firm. UHY is a top professional firm in the U.S. We have almost 1,000 employees, 21 offices across the state, our country, and we're part of the 16th largest international business accounting group. Our practice goes through all different levels of the not-for-profit industries. We audit and provide services for over 360 not-for-profit clients, and we're in the arts and culture, health and human services, education, foundations, private clubs, religious, trade associations, government agencies, and other public sector organizations. Our team is dedicated to the not-for-profit practice and spends multiple hours training just specifically for the not-for-profits. We utilize several resources to ensure that our staff keeps updated, and we try to do these periodic training sessions for our clients to keep them up to date with what's going on. We also do e-blasts and a quarterly newsletter that focuses on the not-for-profit industry. These are some of the services. We're full range on all services between attest, tax, and any other advisory services that we might be that a not-for-profit would need. Here's our agenda, and going forward, Annie Finn will be our moderator. We do encourage questions that will be answered at the end of the program. Thank you.
Good morning. Our first presenters are Alex Zhang, partner, and Brian Kearns, principal of our Albany, New York office. They are both leaders in our not-for-profit practice and will be giving an update on accounting standards.
Thank you, Annie. Let's move on to the next slide. And here is today's agenda. Brian and I will update you on the accounting update in there. So we will focus on the accounting updates effective for the calendar year 2020 and also for the fiscal year 2021, which is really now. We will also introduce a new accounting update 2020-07 related to the gift in kind, which will impact most of the audience today. In addition, we also listed all other ASUs for your reference. We will not go through all the other ASUs in details, but if they are applicable to your organizations and you have questions, please feel free to reach out. Move on to the next slide, Brian.
Thanks, Alex. So yeah, start with some good news here. I guess, one good thing from the COVID-19 pandemic was in June of 2020, the FASB issued ASU 2020-05, which effectively delayed the implementation requirements of the revenue recognition standard under ASC 606 and by 1 year. And then also the lease standard under ASC 842 was delayed by an additional year. And there is some confusion out there with when the lease standard was actually effective for adoption. And, because originally under ASU 2016-02, it was originally effective for 2020, this year. But in July of 2019, it was delayed 1 year until 2021. However, under this standard that was issued in June of 2020, it's been delayed further an additional year to 2022. So a lot of you that haven't adopted this standard yet, you do have an additional year to implement. So moving on, next slide. So with the revenue recognition under ASC 606, since it was effective for calendar year 2019 and fiscal year 2020, the majority of you, or a lot of you, probably have already adopted if you've already had your audit complete. But I know when the pandemic hit, a lot of audits were delayed, even for calendar year ends, but certainly some of the fiscal year ends for June 30th, for example, where you're just having the audit this summer or fall, you may have delayed the revenue recognition. So we won't go in detail under the requirements, of course, as we've done that in previous trainings and slides. And of course, if you need guidance, please feel free to reach out to us. But, just a reminder, it's that 5-step model of revenue recognition, along with additional footnote requirements that are required. And so there's not going to be an impact for a lot of organizations, where revenue recognition isn't significantly impacted. However, if you are recognizing certain revenue under multiple performance obligations, or you even receive dues or fees on an annual basis that isn't consistent with your fiscal year end or your calendar year, there could be some significant impact on when and how you recognize that revenue. So you just want to be aware if you haven't adopted that, to make sure it's complete. Next slide. And then with the lease standard, of course, I think everyone sort of welcomes the good news in terms of delaying it yet another year, because a lot of entities are still in the process of gathering all the required information to properly account for the lease standard. And again, we've had significant trainings in the past on all of the detailed accounting requirements for this, and now that it's not really required until calendar year 2022 or fiscal year 2023, we won't go into really further detail today. It's just a high-level overview. But just as a reminder, any lease right now, all leases over 1 year will go on your balance sheet. So whether it's an operating lease or a finance lease, if it's over 1 year, it'll become a right to use asset on your balance sheet with an offsetting liability. You'll still have operating leases and finance leases, and the difference between that is really on the income statement, how you recognize that expense. With operating lease, it's going to be both the amortization / depreciation piece and interest is going to be recognized, netted together, as one line item, similar to your current rent expense for operating leases. Where finance, you'll still have the principal portion being recognized in a separate interest piece. And then that goes with the cash flow too, where if it's an operating lease, it's all operating, where if it's a finance lease, you're going to have the principal payments be a financing activity, and then the interest piece being operating activity. Moving on to the next slide, I'll hand it back to Alex for ASU 2018-13.
Thank you, Brian. And ASU 2018-13 is meant to simplify the disclosure for the fair value measurement. So for non-for-profit organizations, and if you have investments, endowments listed relevant to you. The effective date for this ASU is the calendar year 2020 or fiscal year 2021. So it is now, and early adoption is permitted. So what is this ASU about? And if you recall, the fair value of the investment have 3 levels. Level one refer to those investments having active market and quoted price, like the stocks traded on the Wall Street. Level 3 refer to those investments with the difficulty to evaluate due to some of the inputs and the measures are not observable, such as the real estate properties, partnership investment, or the alternative investment. So this ASU remove the certain disclosures mainly related to level 3 investment. So for example, the valuation process for level 3 fair value measurement has been no longer required. And similar as for non-public entities, and the change in unrealized gain or loss for the level 3 investment held at the end of the period are no longer required to be disclosed. So move on to next slide. Continue on this ASU, there are some modifications in there brought to your attention. So for level 3, the roll forward schedule reconciliation from the beginning balance of the investment to the ending balance is no longer required for non-public entities. I do want to point it out, however, you are still required to disclose the transfers into out of the level 3, but also be careful with non-public entities. I know that some of you on the call, our audience, including college or universities, and you may have a public debt or bonds traded on the OTC market. So you are considered a public entities. In that case, you are still required to disclose the roll forward schedule for level 3 investment. In addition, this ASU 2018-13, basically all the entities are no longer required to estimate and disclose the timing of liquidity if you have the investment value at the NAV, the net asset value. Before, you are required to disclose the timing of liquidation. If you don't know, you need to estimate, disclose that information. But now you are no longer required to if you don't know. But you do need to disclose the fact you don't know the liquidation event. And if for some reason the investee brought to your attention, or there is a public information available for the timing of liquidation event, you do need to disclose on the financial statement. So move on to the next slide. The ASU 2019-03 is related to the collections in there. So what is collection? Collection, this ASU basically clarified the definition of collections, including grouping of art, historical treasures, and similar assets that I have 3 features. 1, held for the public. 2, preserved and protected. And also when sold, the proceeds are reserved for specified uses. So this ASU impact not only non-for-profit, such as museums, libraries, zoos, and I know some of the, our audience are the museum organizations or libraries, but also for for-profit entities. And if you are maintaining this type of collections. So under this new ASU, the proceeds from the sale of collection items, which we normally call a de-accession, removed from the collection, the money can be used either to acquire the new collection items or can be used for direct care for existing collection items. So this is a good change for the non-for-profit organizations if you have collections. Before, the previous guidance only allow you to use the proceeds from the de-accession only for the acquisition of the new collections. So now you can use for the direct care. So you're gonna ask, what is direct care? Interesting in this ASU have no definition of a direct care, but you are required to disclose what is direct care. AICPA did look into this issue, issued a Q&A, and based on the AICPA guidance, when determining which cost is the direct care, you are needed to consider the following key 3 factors. Number 1, the direct care is able to enhance the life usefulness or the quality of the collection. Number 2, the direct care will be able to provide a benefit to the collection, not to the whole organization as a whole. Number 3 is very important. Direct care excludes all expenditures that are regular and ongoing in nature, such as expenditures for routine maintenance of the collection. So such as utility costs will not be considered direct care. So you need to be careful to understanding this ASU and relate to the AICPA guidance on that. Move on to the next slide. I'll turn to the Brian.
Yeah, so 2020-07 is actually pretty interesting and will impact quite a few of you as non-for-profit organizations that receive gifts in kind or contributed non-financial assets, and this is really hot off the press. It was just issued a little over a month ago in September of 2020. And while it's not effective for a couple of years, for fiscal year ending June 30th, 2022 and thereafter, so calendar year 2022, for those on the calendar year, we do want to make sure we bring it to your attention because early adoption is allowed, and it's actually useful information for the readers of the financial statements. And it was really issued in the same spirit of ASU 2016-14, which was the new non-for-profit reporting model that many of you adopted last year and the year before, which took your net assets from temp restricted, perm restricted, unrestricted, so with and without donor restrictions. It expanded the functional expense categories and also the liquidity footnotes, which was all in, the purpose was to add transparency and usefulness to the readers of the financial statements. And this is in that same spirit where it's taking, gifts in kind, and expanding the requirements for the accounting for it. It's not really changing the accounting for it too much, but it's really just the disclosure and how it's presented in the financial statements. So next slide, just as a reminder, what are gifts in kind? Of course, they're contributions and non-financial assets, donations to your organizations, and they could be tangible properties, or they, such as, equipment or facilities. It could also be, inventory that you end up, or charitable contribution that you end up auctioning off, for donations where you monetize it versus utilizing it yourself. It could also be professional services that you would have otherwise, paid for, such as legal or medical, services, accounting, consulting, etc. So on the next slide, what does this ASU actually, do, and what does it change? And in a short summary, it's basically taking on your statement of activities or your income statement. It's making sure that the revenue recognized from these donations is on a separate line item. It's no longer grouped with other contributions. So we'll have its separate line item, and then it's disaggregated into categories by the type of gift. And that could be in the footnotes as well, such as, again, building and equipment, food, services, etc. And then for each of those categories, you're going to have to, disclose, certain qualitative information about those contributed non-financial assets, whether they were, utilized by your organization or they were monetized and, turned into, cash or other contributions or other revenue from your perspective, and then also your policy on how you monetize it, and then a description, associated with the contributed non-financial asset if the donor imposed any restrictions, and then also how it's valued, and we have some examples that Alex will run you through now.
Thank you, Brian. And as Brian mentioned, that this ASU really require a more prominent presentation and enhanced transparent disclosure related to the gifts in kind. And almost, I think, many of the audience in today's webinar had that gift in kind situation. And also, as Brian mentioned, the refreshment merit gift in kind, including tangible, intangible, such as donated service, would fall into this category. So we do believe this is very important change and important to the non-for-profit organization down the road. You need to be prepared. So follow on Brian mentioned the change of this ASU. We just want to provide you a couple of examples how the change will be reflected on the statement of activities and also the disclosures in there. So you have some of the template, some of the examples you will be ready, you can look into when you get into the point for implementation this new standard. As Brian mentioned, on the state of activities now, the contributions of the gift in kind, or called the non-financial assets, are required to be separately disclosed on the income statement. So on this example, you can see before you have contributions, and one line, now you are split into the cash, other financial assets, and also the non-financial assets based on the with or without donor restrictions in there. So move on next slides. And a lot of the new disclosure is also required. And in here, basically, you can tell is the gift in kind are required to be disaggregated into each category based on the type of the gift. So this example disclosed by each category, you are required to disclose the revenue recognized. And if we utilize for the program, you are required to disclose which kind of program, what kind of activity you use that gift in kind. This is a very detailed disclosure requirement compared to the current practice in there. And if there are any donor restrictions, they are also required to be disclosed, including the fair value. How on the initial recognition, what the value you put on the book, what kind of valuation techniques and inputs you utilize, including the primary market you use to evaluate the gift in kind. So flip to next page again is more information, more category of the examples we just want to put in here for your information and reference. So move on to next slide. The other ASUs effective 2020, including the callable debt securities, derivatives and hedgings, shared-based payments, VIEs, financial instruments on the next page from the page 21 to the page 29. And this may not be relevant to most of the audience here, so we will not go through those ASU in details. But if it's relevant to you, and you can always refer to these slides included in here and reach out if you need. So with that said, conclude our ASU update. Annie, please move on to the page 30.
Thank you, Alex and Brian. Next, we have Ali Beydoun, a principal in our Farmington Hills office. Over the last several months, he has immersed himself in the Paycheck Protection Program and will be covering PPP and the forgiveness process.
Thank you, Annie. So a 15-minute session on PPPs down from the typical hour webinars is going to be a fire drill. I think we tried to break down the session in a couple of the key categories. One is now that we are essentially, for most applicants, we're outside of the covered period, and most banks, some are still lagging, but most banks are starting to accept applications. The key is, how do we go about applying, which form applies to us via the forms that are currently out there. We're going to do a quick refresher on, what expenses qualify for forgiveness, what are some of the caps that you need to be aware of that, might be more applicable to nonprofits rather than the for-profit stuff where owner employees can come into play. And then ultimately, walk through some of the certification, the SBA necessity questionnaire that came out for loans that are over 2 million that talk about the audit process, essentially, the SBA is going to be reviewing to determine whether the loan was warranted to begin with or not. So we're going to start with kind of how do we go about the application. I know this slide is a little bit small, but I think the slides will be available afterwards. But this is really from the instruction of the application. So technically, right now, there are 3 applications out there for PPP forgiveness. We'll start with the 3508S, essentially is the newest one that was issued. That was for loans over $50,000, and it's pretty much just a certification form. So we're not sure how much application that's going to track. But anything over 50,000, you can go one of 2 routes, which is the normal route or the easy route. And so you start with looking at your EZ form and figuring out if that applies to you or not. And there are 3 requirements in the EZ form. If you meet any of them, then you could utilize this form. And the advantage of going EZ over traditional route is the EZ form does not take into account any of the FTE or salary and wage reductions that could be applicable to a borrower and that would otherwise reduce their amount of forgiveness that they're eligible for. So you always want to make sure, do you qualify for the EZ first, because that's the path of least resistance. And if you don't, then you default to the regular application. And really the key behind the EZ, the first bullet doesn't really apply for the nonprofit because it applies for self-employed individuals. It's the second 2 that are really the most applicable. And the second one is the borrower did not reduce any wages by more than 25%, and the borrower did not reduce the hours of employees between January 1st and the end of the cover period, including essentially hours that the borrower has offered to restore back and try to bring back the employees, but the employee has refused to come back. And so in essence, if there was no voluntary reduction that is from the borrower's end. It's all, hey, the employee left on their own accord, or we laid off employees, we tried to bring them back and they refused because they're on unemployment, and we did all the right things to inform unemployment. Then you should be in okay shape to maybe check this particular safe harbor. This is a pretty objective safe harbor. It's a numbers game. You just got to make sure that you didn't have reductions essentially throughout the end of the covered period. The second item is you didn't reduce the salary and wages of employees over 25%. And then there's a subjective safe harbor that was introduced by the Flexibility Act that essentially says that if you were unable during the cover period to operate at the same level of business activity that was there as of February 15th because you were complying with the requirement established and the guidelines established by the various governmental authorities related to COVID, then you should be able to check that. That's essentially if pretty much if a shutdown order impacted you and forced you to shut down your operations and you couldn't operate because of that, then essentially you would end up being able to potentially check this box. So if you meet any of those two particular items, then you can go the easy route. And as I mentioned, the easy route provides for not having to worry about any FTE reductions or salary and wage reductions that would be applicable. Anybody who doesn't qualify for those items would default to the regular application, and the regular application requires you to go through all the FTE calculations to see if you had a reduction. Please note that essentially the reduction applies on the amount of expenses that you've incurred. It's not on the loan amount. So in essence, now you have 24 weeks worth of expenses that you can include. So if we can go to the second slide, we can go through a refresher of what type of expenses would qualify. So keep in mind that covered period is the 24-week period that is from the date that you've received your loan forward. For any borrowers with biweekly or more frequent payroll, for payroll costs only, they can use an alternative cover period that starts on the first day of the first payroll post the time you've received your money. And so for payroll cost, the qualifications there is it's cash compensation, and it is capped at a $1,923 per week per employee for a total of $46,153 for a 24-week covered period. If you have health insurance, that's going to be the employer portion of health insurance, so you gotta remove anything that the employer reimburses. Retirement match for any type of retirement plans that you have a match for, and then ultimately state unemployment taxes. That gives you your pool of payroll costs. The non-payroll costs that can be used are essentially mortgage interest, utilities, and I think rent fell off the slide. But rent and that for both personal as well as real estate properties do qualify. It's important to note that for all of these non-payroll costs, you have to have the contracts in effect before February 15th, 2020. So anything that you've entered into after February 15th does not count. And the split between payroll and non-payroll cost is no more than 40% of the forgiveness amount can be attributable to non-payroll cost, which we believe now with a 24-week period, very, very, very few would run into that issue. We've been seeing that a lot of clients should have more than enough expenses essentially to cover the loan. The loans, it's based on costs incurred during the period, so paid during the period, or if it's at the tail end of the period, if you incurred it but paid it outside of the cover period, as long as you pay it within the normal billing cycle, you should be able to prorate the amount that's attributable to that cover period back into the expense pool that would be eligible for forgiveness. You do have the FTE reductions and the salary and wage reductions. We're not going to go into details on those because of time constraints, but essentially those are still out there if you go the regular route, where you have to benchmark your FTEs during your covered period against one of the reference periods that are out there. And if you have any reduction, you have to reduce the amount of expenses by that. But again, with 24 weeks, we're hoping that people have enough expenses to kind of overcompensate for any reductions that come in through an FTE or a salary and wage reduction. So if we can go to the next slide, please. So the certification and the SBA necessity questionnaire that's out there. So this is just for loans that are over $2 million. When applicants were going for the money back in April, May timeframe, you had to certify that the current economic uncertainty makes this loan request necessary to support ongoing operations. Then the SBA came out and said loans over $2 million are going to be automatically reviewed. Well, over the past 10 days, they've issued these SBA necessity questionnaire, one for profits and one for non-for-profits. And, you know, this is more of a hindsight type of questionnaire. So it's looking for the activity assessment as well as a liquidity assessment. And essentially it's reviewing the impact on gross receipts, on expenses, and how the operation has been impacted by COVID post, and mainly through Q2 of 2020 compared to Q2 of 2019. And it's also looking at what available liquidity did you have at the end of the quarter preceding your loan application. So essentially at the end of Q1, how much liquidity did you have on your balance sheet? And based on that, the SBA is going to render a decision as to whether it deemed that you truly needed the money and it was the loan was warranted. And if that's the case, then you would be eligible for forgiveness. If they deem that, you know, that money was not, you know, you didn't need this certification, then the borrower will not be eligible for forgiveness and would be required to pay the loan back. I haven't seen much of clarity on whether they're gonna force the loan back in a more aggressive payback pattern than the 2 years or the 5-year potentially 1% that's currently out there. So it remains to be seen. It remains to be seen how those questionnaires are really gonna be viewed. They're very small questionnaires. There's very limited ability to explain things in them, and I think people are still working through wrapping their heads around what these questionnaires are going to really bring and how they're going to be perceived by the SBA. But there's no question that, you know, while you were making the certification back in April and you didn't have the benefit of hindsight, the SBA has taken a hindsight 2020 approach on these. So I would encourage anybody over 2 million to review these questionnaires. And then last, before I pass it on to the next session, couple of items that, you know, are not on the slides, but we just wanted to cover is for anybody that's looking for the gap treatment on this. I think for nonprofits, you have one of two routes that you can go with. One is the debt forgiveness route, which ultimately says until the SBA signs off on your forgiveness, you treat the loan as debt, and you have to carry it on your balance sheet until it's fully forgiven. Or you can go more the government grant accounting route, which means that if you substantially met all of your duties under the loan amount, so you've spent the payroll, you're expected to get 100% forgiveness, then you can probably remove that and recognize it as grant income while you know, you're still kind of going through that forgiveness process. So those are the two alternatives that are out there for nonprofits. And again, I'm happy to answer any specific questions at the end of the session. So Annie, back to you.
Thank you. All right, up next we have Marlene Beach. She is a principal in our Farmington Hills office. Marlene has extensive experience in governmental accounting and auditing. Today, Marlene will be covering the implications of COVID-19 on operations and internal controls.
And next slide, please. Good morning, everyone. As you probably are well aware, things aren't the same that they were a few months ago. Internal controls I've got at the office and beyond. We started with internal controls we're looking at strictly in the office. Now internal controls are all over the place. Next slide, please. As a part of the audit, what some of the things we're going to be looking at are going to be expanded a little bit. We used to just look at how, you know, things happened around the office. What did you do to keep track of A, B, or C? What was the procedure for this? Unfortunately, now we're going to be testing a whole lot more. There's a potential for 3 sets of controls. Number 1, pre-COVID. As I just mentioned, we kind of look at what happened in the office. How were things handled? Number 2, mid-COVID. What's happening right now? How did things change? How did you go to remote operations? What are you looking at now? What kind of controls are in place for that one? And number three, if we ever get to it, will be post-COVID. That's the transition back to the office, if that happens. We know a lot of people are changing the way they're doing business. We have people that are going to probably continue to work from home, offices that may never be opening back up that have gone to remote operations. So once again, when we're looking at your audit, we're going to be looking at three separate things. Like I said, what was in the beginning and kind of in the middle, and then how things end back up. Next slide, please. Some of the things to consider when you're thinking about internal controls, as I just mentioned, you're moving, from the office to telework. Have you got any new programs? We have a lot of not-for-profits that are now getting grants. We have CARES Act, HHS funding, and some of these entities have never had a single audit before. A single audit relates to any expenditures of federal funds. If you expend more than $750 in any given year, you'll be subject to a single audit. So there'll be some of you that did get some federal funds in 2020, 2021 that may have never had a single audit. It's going to be something to consider. And once again, this is money that you expend during the year. So if you expend more than $750,000, your audit net will now include a single audit. Part of single audit testing is looking at internal controls. So did you have new programs? What's going on with your employees? Did you add employees? Do you have different employees? If you changed anything with employees, how did you change the controls related to their access? What about your furlough employees? When they were laid off, when they were on furlough? What was their computer access? Was it terminated? Was it put on limited? Where are your employees accessing the internet from? Are they going to Starbucks? Are they using a public Wi-Fi? So we're not only looking at who's new, what's new, but where are they accessing it from? So that's something to consider, is looking at where your employees are accessing your company records from. Are you using a private network? Or are they using a public network and now they've just possibly exposed your company to added risk? And as I mentioned earlier, there's the back to work. So once again, we have the three different scenarios. Next slide, please. One thing you want to consider is, how have your controls evolved? You're not looking to change things drastically. You're not looking to do the get around to see what we can do to not do these controls. It's what we've had to change to get to these controls. And one of the things you're going to want to do is a short document that kind of lists all this. Doesn't have to be as detailed as your normal internal control documents would be, but maybe a memo that says, during COVID, we did A, B, or C, or D. We changed our operations by this. While we were going back to work, we did these changes. Here's how we operate now. And the third one may be, now that we are back to the office, if that's the case, here's what we're changing. Or here's things that we have permanently changed. We found that, this may work better and we're going to switch to this. Like I said, it doesn't have to be quite as detailed as your normal internal control policies and procedures, but a memo. So when we come in, we can look at it and say, okay, great, this is what you've done. Here's what we can look at. And you don't want to throw a control out just because you're now remote. It's, my checks used to use checks and used to have them signed by two people. It's a little tough to get checks signed when nobody's in the office now. So have you gone to electronic banking? If you've gone to electronic banking, what controls have you put in place? Are there different ways to review things? A lot of times people are used to signing off on something, actual physical signature, a stamp. It's a little tougher when you're not in the office. Does your system allow for virtual correspondence? Does it allow for virtual confirmations of things? Is there a way to date stamp something in your computer system? A lot of accounting systems do have audit trails, which can show, we can see the reviews. Some of the simpler ones may or may not. But look for different ways. If you're used to, walking over to somebody's office to have them sign the checks, are you sending them an email? Keeping the email list confirmation. Here's the email where I ask you, here's the bills I presented, and here's the response back from the person that says it's okay to pay A, B, C, or D. A different way of doing control. It's not circumventing the control. It's just changed a little bit. Shared drive versus a standalone computer. I kind of mentioned that is, you have a virtual network. How are people accessing the network? As I said, where are they accessing it from? All things to consider. Like I said, you don't want to throw out your internal controls. You just got to look for different ways of doing the same thing. Next slide, please. Okay, I mentioned a single audit. Like I said, a single audit is when you spend federal expenditures in excess of $750. Doesn't matter how much you get. It matters how much you spend in any given year. So if your award, even if your award is $1 million, if you only spend $650,000, you're not subject to a single audit. So once again, this is use of federal funds in excess of $750,000. Moving on. As I mentioned earlier, there's a lot of CARES Act money that is out there. People that haven't had federal funds before are now getting them. Federal funds, like I said, are subject to single audit. And anytime you're spending federal money, you have to go by the federal rules. Normally, if you get a grant, they should be telling you what the CFDA number is on it. And that's a number that you can go and reference. And that's where you can go to the federal website, and they kind of give you the rules for how to spend, what to spend on. They have been a little looser with CARES Money Act because they gave the money out and then they came up with rules. Rules still are not finalized on some of the money. So one of the things, if you are spending CARES Act money, is document. Make sure you write down, document everything that's you decided how to use the money, what the money was used for, where it went for, what your controls are. It's better to have over documentation than under documentation on federal funds. What kind of controls do you have on the expenditures? It's one of the big things that the feds are looking at is how was the money used? How did you control the money going out? Did you just hand it out? Are there procedures that people have to follow to make sure the money is getting properly handled? Do you have correct, sufficient authorizations? Are somebody else looking at it? Are you the banking? How's the money going out? How are purchases getting approved? Are you looking at vendors prior to approval? We did have some limited issues, with some of the money coming out that there's only single source vendors. If that's the case, just document that. We looked around for vendors and there was only one available. Therefore, we went with vendor A for this reason. Like I said, the rules have been a little loose. As Ali mentioned at PPP, sometimes the rules are coming out after the money. That's what we're seeing with a lot of the CARES Act. So, like I said, just make sure you document everything. Next item, please. Segregation of duties. Segregation of duties is a key internal control, and it can be a little tougher with remote operations, but it also can lead itself to splitting the duties up a little more. We've always seen with the smaller organizations, it's tough. How do you split up the duties when there's only one of you in the office? How do you split it up now that you're the only one that comes in and everybody else is working remote? As I mentioned earlier, look for ways to do things remotely. Look for, approvals remotely. One of the things you can do with online banking is one person can upload and somebody else can approve. Now you've got a segregation of duties. One person can't take it from A to B, and that's the whole point. You don't want somebody to take something from start to finish and nobody else oversees it. One other thing to consider is board members. If you've got an organization where there is only one or two people in the office, look for board members to maybe be involved. You don't have to have an accounting degree to review a bank reconciliation. Some of the things you want to kind of look at is just things that don't look right. If you see 4 checks for $10,000 each, is that normal for your business? Is it not normal? Checks written to specific people that probably shouldn't be. New vendors, kind of things to just key into and look for. Next slide, please. Fraud in the COVID environment. Fraud's always out there. What's happened during COVID is there's different ways to commit fraud. Fraudsters are always going to come up with new ways to do something. That's kind of what they live for. So you just want to be a little aware of things that could happen. You may have people that never thought about fraud before, but maybe without incentives, different ways of doing things, some pressure at home, different opportunities, there might be fraud going on that possibly somebody else wouldn't have committed before. A couple of different venues for fraud is corruption. As I mentioned earlier, especially with single audits, you want to make sure that you're doing reputable vendors. You want to make sure that your customers are legit. Bribery is always there. It's just, once again, in this COVID environment, it could be a little more prevalent. And, is anybody looking at kickbacks? Are bids being done properly? Are bids being set up so that only one person can win them? Just some things to think about. Next slide, please. Another way to commit fraud is financial statement fraud. Especially now, a lot of nonprofits have had to cancel numerous activities. So the net income is down. We're expecting to see that. We see institutions where their income is up, especially we see like special events income. That's going to be a red flag. Fictitious revenue schemes. Another way to make your income statement a little better is you don't record your liabilities. You don't record your expenses. Once again, these are always out there. They're just to keep an eye on a little bit more. What about the value of the assets? Have asset values changed? We haven't seen a whole lot, but you never know what's going to happen from day to day. It's just something to look at, the valuation of the assets. Next slide, please. Are your assets coming up missing? Did somebody walk off with some cash? How's cash coming in? Is cash even coming in anymore? What about your inventory? Is something just to maybe look at? Has anybody checked what's there? If you've been totally shut down, is your inventory still there? Has it happened to walk out? Fraudulent disbursements. Check your, especially with your PPP loans. Make sure your employees are your employees. Next slide, please. And that's it for my section. I'll pass it back to Annie. We do have some questions coming in. As I said, we will address them at the end. We do have questions on the CPE, and we will address that at the end also.
Yes, thank you, Marlene. One housekeeping item before I introduce our final presenter. If you require CPE, please be sure to complete the survey that will be sent to you by email. Now introducing Melinda Altamore. She is a senior member of the Audit and Assurance Department in our Ann Arbor, Michigan office. Melinda will be discussing why the Form 990 is an important tool for nonprofits.
All right, thanks, Annie. Hi, everyone. All right, today we're going to talk about telling the not-for-profit story through the Form 990. We're going to discuss how the 990 narratives can be utilized as a marketing tool. Next slide, please. Okay, GuideStar. GuideStar worked with the IRS to make digital copies of the Form 990 filing available on the web starting in October 1999. So GuideStar, about 2/3 of the visitors who go to GuideStar's website look at one or more Form 990s during their visit. Many of us don't realize, but they may be looking at one organization. They're always looking at a couple more while they're there. Organizations need to think of the Form 990 not just as a regulatory tool, but an opportunity to help people understand their organization. Next slide, please. So the Internal Revenue Code. Section 6033 of the Internal Revenue Code requires most tax-exempt organizations to file an annual informational return, which contains the income, receipts, disbursements, and other information. This straightforward requirement, all of us not-for-profit organizations know what this is because it has to be completed and submitted to the IRS every year. Charitable organizations can capitalize on this compliance requirement by using it to educate donors and market their organization and programs. Next slide, please. So we're going to go through some scenarios. So scenario 1, you have Student Saving Riverdale, Inc. This organization has a new funding, or is a new funding organization that requires a financial audit. The executive director contacts UHY to inquire about obtaining the audit and the associated fees that go with that. Before agreeing to meet with the Student Saving Riverdale, UHY, just like any other auditing firm or accounting firm, will look up the organization's Form 990 to learn more about its operations and viability. Next slide, please. Scenario 2. Steve Smith, who's a CPA, has been asked to serve on the board of Sunshine Solutions. Before accepting the offer, he examines the organization's Form 990 to determine whether the mission and programs of Sunshine Solutions are aligned with his values and priorities, and if the governance structure has been established in a way that will protect him as a board member. So this is just another scenario. Each of these, all of us have probably heard at some point. They're very common scenarios. So our last scenario, next slide, please. Toy Story Charities has applied for a grant from Buzz Bank Foundation. Part of the award selection process involves reviewing the Form 990 to determine whether the mission and accomplishments of Toy Story's programs are aligned with the purpose of the foundation grants. Next slide, please. So considering these scenarios illustrate how individuals use the Form 990 to perform due diligence in considering whether to commit time or resources to a specific not-for-profit. These time and resources could be as a service provider, a grantor, or a board member. In fact, the 2019 instructions for the Form 990 state, some members of the public rely on Form 990 or Form 990-EZ as their primary or sole source of information about a particular organization. How the public perceives an organization in such cases can be determined by the information presented on this return. So this right here, obviously a lot of us don't read the Form 990 instructions for fun, but this is on the first page of the instructions right in front of you, which it clearly is telling us that to file this return, we should think more than just filing for compliance. We should be thinking possibly how this specific form can be used to benefit us additionally than just filing for the requirement. Next slide, please. So impact on organizations. As the number of not-for-profits continue to increase, the competition increases for the same pool of donors. All of us know this. So each organization needs to be strategic in communicating its mission, focus on marketing strategies that work alongside the organization's tone, and fundraising. So with each of these three, you want to bleed through what your purpose of your organization is, and the tone across all of them should be the same. So it sounds like it's coming from the heart of the organization. Next slide, please. So the Form 990 gives a snapshot of the financial health, as we all know, the governance and operations all in one document. So the governance and operations will get in more detail, obviously, in those narrative sections where you can provide more detail as to these items for the organization. The organization can sell themselves in the mission and program descriptions required on the Form 990. The Form 990's narrative sections tells the not-for-profit story of how the organization is fulfilling its mission. Next slide, please. So who's reading and why? Not-for-profit organizations and CPAs are mistaken if they think no one is actually reading the information on these forms. So Section 6104B requires not-for-profits to make their Form 990 available to the public, unlike their financial statements, which I had said before. This is the one document that is accessible to the public. Rather than shrinking back from the requirement and minimizing the amount of information provided on the Form 990, organizations can make the most of the requirement by telling their story and selling their organization. Next slide, please. So what readers are looking for? These are just 5 types of users. So we have our donors and grantors. So their objectives for looking at the Form 990 would be to ensure the mission aligns with values and goals, evaluate the governance structure, policies, and compliance, assess the program accomplishments, and to make sure those programs align with the mission. Our potential board members also are looking at the mission, making sure that it aligns with the values, and they're also evaluating the governance structure, policies, and compliance. Creditors and banks, they're evaluating the governance structure, policies, and compliance mostly. Vendors and service providers, they determine whether the service offerings meet the not-for-profit's needs. The service offerings, a lot of times you can put those details right in your program description. External evaluators, they're going to be evaluating the governance structure, policies, and compliance. And then they're also going to be looking at the program accomplishments and alignment with those programs to the mission. Next slide, please. So what is a common thread among these readers? The common thread is that they all are using the Form 990 to make decisions that affect the organization's ability to obtain funding, provide services, maintain proper governance, and ultimately achieve the goals for which it exists. So again, these readers, there may be readers out there that you never make face-to-face contact, that they may never have known about your organization prior to because they've never crossed paths with anyone connected to the organization. But on GuideStar and with this Form 990, they can make contact with your organization without actually meeting you first, which is a benefit that many of us could take advantage of. Next slide, please. So our narrative sections, we're going to get into a few of the narrative sections that I think should be always the first target when you can amp them up to help with the marketing side of things. So the common thought, as I had said before, since the Form 990 is submitted to the government, less information is better. It's a compliance requirement, you know, just get it in, make sure you check all the boxes that the IRS wants and call it good. But that's not always true, obviously. Not-for-profits should be eager to take advantage of the opportunity to tell their story through their Form 990's narrative sections. A story of the organization's mission, partnership, and client support. The sections that organizations can use to tell this information include, so part one, the summary, line one. This is going to be your mission or most significant activities, so it's right on the first page. You have part three, which is going to be your statement of program service accomplishments, line one, which is again your mission. Then can be your mission. We'll get into that later. Part three, you have your statement of program service accomplishments, line four, which line four is A through D. So you can provide 3 detailed descriptions of your 3 major programs, and then in that last line, 4D, you can add a 4th one. Usually it can be more general, might encompass a couple of activities in one, because the 3 big ones will be your line 4A, 4B, and 4C. And then Schedule O, this schedule is supplementary information to the Form 990 and 990EZ. So this is just going to be a continuation of the narrative sections, as well as an explanation of other answers within the sections. But it is a continuation, so there is no limit on your narrative sections. You can always add as much information. Obviously, you don't want to add too much, but you definitely can continue on. Next slide, please. So communication with words and numbers is a big thing, and both those aspects can be included in all your narrative sections. So common practice to lift from the organization's website and other marketing materials and place it on the Form 990. Now, a lot of those marketing materials don't always go into detail in the way, you know, marketing materials I'm referencing might be you have a fundraising event and you have a brochure that's passed out at the fundraising event. So those marketing materials don't always, you know, a lot of times those marketing materials might just be speaking to the people who are attending the event, which a lot of the people who are attending the event already know about something about the organization. So those marketing materials, using that information doesn't always give that reader who doesn't know anything about your organization the information that might pull them in to continue reading and then to also possibly get involved in your organization. So however this may not be the best way to communicate the organization's mission, programs, and values, which is what I just was referencing, the organization should consider the audience they're speaking to, which goes back to me saying that your audience for the 990 a lot of times might be someone who has no idea about your organization, who, like I said, hasn't been in contact with anyone inside the organization prior to them pulling up your return on GuideStar. And also the organization should develop focused messaging. So you want to bleed through the entire return, the tone that is consistent from the start to the end. After these two issues are determined, messages can be crafted that focus on communicating with a particular audience. Next slide, please. So content should be centered on the organization's unique qualities, programs, and clients. What makes you different than other organizations out there? The method of accomplishing its missions. So you want to tell the reader, yes, this is our mission, but this is how we're achieving that, and this is how we're staying in line with what our original goals were. The results of its program. So this is quantitative and qualitative. Its value to the community. So why your organization, why someone in the community should be involved in the organization. What they should, why they should be pulled towards you to help with your mission at the end of the day. Also, the organization's effectiveness and efficiency is using its resources and responding to challenges. So an example, for an educational program, so again, you have your educational program listed as one of your program accomplishments. So for an educational program, describe the type, the number of classes offered, the number of pupils participating and completing the program, and how successful the participants were compared with a similar population not receiving the same services. Next slide, please. The style of writing used in the narrative sections is just as important as the content. Like I said, that tone. Sections should be clear and convincing. Donors and other audiences may not understand terms unique to the sector or to the particular field of work. So also thinking that this reader may never have been associated with a type of organization, or may have never been associated with the work that you are trying to achieve with your organization. So you have to remember that. Remember that outside reader, inside terms that you might use just may not connect with them. They might not fully understand what you're trying to get at. So for potential donor audiences, these messages should convince the reader that the organization is worthy of their contribution. So again, with keeping the terms in your descriptions open to everyone, and then also allows them, so keeping it open to everyone allows them to feel connected to your organization, even though they never knew about your organization. So that makes their contribution, they feel, yes, I want to donate to your organization because I feel my contribution is worth something. Next slide, please. So here's examples of ineffective and effective narratives. So what do actual narratives look like? They can be brief or extensive. They can be clear or confusing. They can spur the reader to seek more information, or they can miss an opportunity to inform the reader completely. Next slide, please. So here's our first example. So we're going to talk about part 1, summary, line 1, which just briefly describes the organization's mission or most significant activities. So this is on the first page of the return. So not-for-profit A, all they put in that line was see Schedule O. So this would be deemed ineffective because it misses an opportunity to provide the mission at the top of the form. So no information is provided on that first page. And if there's no information provided, what would encourage the reader to flip all the way to the back of the return to Schedule O to read what you had put in there? So not-for-profit B, their line says financial support to cancer patients. This is effective. It's straight to the point. It states what the organization does and for whom, but it definitely can be added to. So not-for-profit C, they say care for the homeless and those at risk of being homeless. So this is effective as well, but it definitely is a little more detailed. You're given a little bit more, not too much, but it states again what the organization does and for whom. Next slide, please. Next narrative section we'll talk about is part 3, which is where your statement of program service accomplishments, line 1. This briefly describes the organization's mission. So not-for-profit A says see part 1. Again, not-for-profit A obviously didn't attend this lecture. This is ineffective because it does not provide new information. It refers to part 1, which if you remember, part 1 said see Schedule O. No information is provided regarding the mission in part 1 or part 2. And again, what is going to make the reader really flip to Schedule O? Not-for-profit B. They say financial support to cancer patients. So they're restating the mission in part 1. But this, and again, it's adequate. It's not ineffective. Again, you're stating your mission, but you're missing an opportunity to provide additional information. So on that page 1, here's our mission. Page 2, let's amp it up. Let's put a little bit more detail in there to grab them a little bit more, because that page 1 had the reader turn to page 2. Next slide, please. So not-for-profit C, the last example. So they say to care for the homeless or those at risk of being homeless in our community through services that alleviate suffering, promote dignity, and instill self-sufficiency, be Schedule O. So this right here, if you remember, they did say they care for the homeless or those at risk of becoming homeless, was what they had said in part 1. Now this right here is extending on that mission, giving more detail, and is also saying to the reader, now flip to Schedule O and you'll get the rest of this. Because that, just like in a normal book, anytime you're reading a book, you always flip to that first page. If that first page does not grab me, a lot of times I don't want to read the rest of the book and I put it down. This right here is grabbing me and then makes me want to think, okay, let me see Schedule O and see what else they had. So not-for-profit C extended into Schedule O, saying 10,500 volunteers. So they're stating a quantitative amount, telling us how many volunteers they had that year. They're saying their support comes from private donations, businesses and corporations, private and corporate foundations, and government grants. They have 5,000 in in-kind services and 10,000 in in-kind food and material donations above financial donations. Volunteer time valued at more than $3 million. So this right here is encompassing much of what might be included on your financial statements that the reader doesn't have public access to unless requested, if you allow them to request. So this would be effective because it states the mission, provides additional information about how the organization fulfills its mission in part 3, then expands into Schedule O with more qualitative and quantitative information describing how the mission is accomplished. So all in all, this is an example of what can be done within one of the narrative sections on your return. Again, marketing your organization without possibly ever speaking face-to-face to this donor or potential donor. Next slide, please. So part 3, this is going to be our line 4. So this is for A, for B, for C, for D. Again, you can have up to 3 programs listed, and then that 4th one can be a 4th program, or it can encompass the rest of kind of what your programs outside of the big 3 may include. So not-for-profit 1 on this line says provides funding for basic needs of our clients and training for our volunteers. I would say this is ineffective. It does not describe the program or provide quantitative or qualitative information about the program's effectiveness. So again, doesn't flag the return that it can't be filed, but you're not utilizing what I think these sections could be utilized for. So not-for-profit B says worked with over 90 participants or participating community, worked with over 90 participating community charities to provide funds for their charitable activities through a matching program based on pledges obtained by charity volunteers. This is adequate. You're briefly describing the program and how it works and provides some quantitative information indicating the magnitude of the program. Next slide, please. So then not-for-profit C. This says, so they put in this first line, provided meals to 50 partner organizations located throughout the local area where anyone who is hungry is fed, 3 million meals, helped 50,000 people with clothing, 6,000 at-risk children received new backpacks, see Schedule O. So this again is effective. It's detailed. It provides me the quantitative, qualitative. It gives me numbers. It gives the reader an idea of what this program is and what this program has accomplished over the last year. And then C Schedule O would be if you had more information, just like before, you would just continue on and it would pop over to that schedule. Next slide, please. So that is a brief description of what these narrative sections can provide, what you can do with these narrative sections. And again, I can't stress enough that with these narrative sections, on top of just putting the information in there, the qualitative, the quantitative, you want to also think about that each of these narrative sections has a tone to it. There has to be consistency from start to finish when the reader, so it still sounds like your organization. It needs to come from the heart of the organization. giving that feeling of what this organization is. And with that tone, you can show the passion for your cause and anything else that really you want to believe. You know, if you were standing face to face with that donor, how would you be describing the organization face to face? That's how you should also be thinking about how you can describe the organization in words within the return. So I'll give it back to Annie. And if there are any questions, I think now is when we will be answering.
Thanks, Melinda. I'm going to ask Marlene to take over the Q&A portion so we can get to some of your questions.
All right, we've had a number of questions come in. I'm going to direct them to the person who actually completed that section. So Melinda, I'm going to start with you. GuideStar.
All right.
Is GuideStar free? Can anybody use it? Because this sounds like great marketing that's free to me, if anybody can get to
Yes. So GuideStar, yes, all you do is create a login. Obviously, if you pay, there are other, you can pay for certain features in GuideStar, but anyone can create a login, go on, and you can just search for any organization. And when you search for the organization, when you click on that organization, there is going to be a spot within there where you can pull up the Form 990s, and they'll have multiple years listed that you can access. So I will note, the only thing that is not available and not public information for the 990 is your Schedule B. So when an organization is completing the Form 990, obviously those who do need to require Schedule B will have Schedule B, but that is not public information because it has donor information on it. So that will be removed from the IRS before posting on GuideStar.
Okay, great, thank you. I guess I'm going to take the next one because it kind of talks about a little bit about just a PPP loan and the $750,000 threshold. I have great news. PPP loans are not subject to the uniform guidance. I'm sure you all thought I was going to say exactly the opposite. So the feds didn't give you a break on that. So the CARES money itself is subject to single audit, but the PPP loan is not. Moving to the next question. I'm going to direct this one to Alex. Alex, we have a question about PPP forgiveness. If somebody has applied for forgiveness and it's awarded before their year end, would this be considered a current year event or a next year event? So in other words, when can they put this forgiveness into the financial statements?
This is a very good question. If I recall the question correctly, basically related to the timing, when how you properly accounting for the loan, PPP loan forgiveness. And I mentioned there are 4 different accounting models out there, which is the debt model, governmental grant model, gain contingency model, and also the government assistance model. For the non-for-profit organizations, for our audience on the call, 2 models applied. You can use 2 models, which is the debt model and also the grant model. So the timing for recognize of the loan forgiveness is different. So let's talk about the debt model. On the debt model, you can only de-recognize the liability and recognize as a revenue on your book only when the loan is wholly or partially forgiven by the SBA. So in the question was raised by the audience, if I assume the organization asking the question on a calendar year basis. So if on the first week of February, which is now, after the year end, you receive the SBA notification said, oh, congratulations, your loan forgiveness has been approved. So for the year closed before the notification, you will not be able to de-recognize the PPP loan. So at the end of the year, again, before the SBA approved the loan forgiveness, based on that model, you will continue to keep the liability on the book as of the balance sheet date. However, if you follow a different model, which is also allowed for non-for-profit organizations, which is the grant model, the loan will be basically treated as called a refundable advance. So similar as a government grant. As we all know, for the grant, you need to make sure the condition is met. So for the PPP loan, there are many restrictive conditions out there. You need to make sure substantively met those conditions as the end of the balance sheet date. If that's the case, yes, you can recognize the revenue and take the loan off the book. So back into the questions the audience asking about is, I would recommend that you look into at the end of the year, which is, I assume, the calendar year, December 31st to 2020 in that case. And before the SBA approve, you're gonna asking yourself if that all the condition has been substantially met. And I also recommend you reach out to your auditors as early as possible, because it will be very difficult for the auditor compared to the data model. Auditor have to do more work, make sure that all the condition has been substantially met. So both of you can be on the same page for recognizing the revenue before the SBA approval.
Great, thanks, Alex. No surprise, we've got more PPP loan questions. So Ali, we're going to punt this one over to you. Somebody said, we've got multiple questions coming in, so hang on. So question one, when do we need to start repayment of the PPP loan for the pieces that were not forgiven?
So essentially, the payments are deferred for 10 months post-covered period. That's when they typically would start, but they would actually start based on when you have received a decision from the SBA. So if you've applied already for forgiveness and they come back and they say, yep, we agree only 80% of your loan is forgiven, here's 20%, they will then give you the payment schedule on the 20% remaining loan as soon as they rendered their decision, and you would start making those payments shortly after that. But if essentially no one applies for forgiveness, the payments are deferred up to 10 months from the end of the covered period is the grace period. After that, you would have to start making payments.
Yeah, we've got another PPP question. So we haven't received the questionnaire yet, and they're ready to apply for forgiveness. Do they need to seek out the questionnaire? So where can they get this information from?
So the questionnaire, ironically, has not been posted on the Treasury website. I believe it's posted on the SBA website. So it is out there. And typically it's coming from also the lenders. What we've seen on our end is a lot of lenders have integrated their portals with the SBA. And then once this questionnaire was launched, it kind of stopped that process because now there's a piece that's not linked that the lender has to manually input. So the lenders are going back to the drawing boards on applications over $2 million to try to update their portals to embed that questionnaire in. But it is out there on the SBA website. I'm happy, Marlene, too, if we want to share it. I have a copy of the latest one that was out there. We can share it with the slides so that the audience has access to it too. So and you have 10 days essentially on the questionnaire to respond. But typically, you have to apply for forgiveness, and either you provide it along with your application, or if somebody has already been in the forgiveness process, they were given then the questionnaire and said, hey, you have 10 days to return this back to us. But if anybody hasn't applied yet, then go through the questionnaire before you even submit your application. So.
Okay, great. Question for Brian. Brian, you've gave them all the new rules that have to come up. People are wanting, where can they find this information, like disclosure checklists? What kind of things does UHY do to help our clients get ready for all this stuff? And is there a place they can go to get this information? Brian, you're on mute.
Yeah, absolutely. Feel free to reach out to your auditor. We can certainly share the disclosure checklists and examples of any of the disclosures with the new pronouncements that are announced.
Great. We've got a lot of questions about the slide presentation. We will make that available. I'm going to let, before we wrap up, I'll have Annie once again explain how to get CEs. As you notice, the last slide, say that 3 times fast, does have our contact information. Feel free to reach out to any one of us with any questions on anything. We will gladly respond. Just going to look through the questions once more. I think we've covered them all. Annie, I'm going to punt back to you and let you tell everybody once again how to get their CPEs, because I do have multiple questions on that.
Wonderful, thank you. And thank you everybody for your time today. A survey will be going out via email to get your CPE, so please look out for that. And if you have any questions, again, feel free to reach out to any of the presenters.
And we do have, we got a couple minutes left. I'm just kind of watching questions as they're coming in. Once again, this is regarding PPP. So Ali, we're back to you again. Is there a minimum amount to request forgiveness?
No, there's no minimum amount. As long as you have a PPP loan, then you know that, and you meet the criteria, that loan should be eligible for forgiveness. I think there's tiers essentially. So less than $50,000, I mentioned, that has a special form, the 3508S. That's a much simplified form. It's mainly just certifications. Between 50 and 2 million, you're not being subjected to the audit questionnaire. Over 2 million, you are. But essentially, at any tier, you should be able to be at least eligible for forgiveness.
Ali, do we have any idea what the turnaround time they're looking at for the forgiveness to get everything approved? What kind of time frame are we looking at? Any idea?
Yes. So it's depending on the bank. By statute, essentially, the banks have 60 days to render their decision to the SBA, and the SBA has 90 days to then, you know, either approve it or deny it. So in total, it could take up to 150 days before you hear a decision. It is not taking that long, but it really is depending on the bank. Multiple banks have seen, you know, different experiences. A couple of the banks that we're working with here, they've seen that loans under $100,000 were moving rather quickly through the system, while other loans are getting stuck. You know, my guess is it's gonna take probably 4 to 6 weeks, is what probably a normal turnaround with between the banks and the SBA. And really, the bottleneck is gonna be on the SBA, because the banks, they're doing some diligence on these loans, they're verifying calculations and stuff like that, but they're not, you know, having to do a lot of legwork on that. And then they can turn it relatively quickly to the SBA. It's just a matter of the SBA then approving it.
Great, thanks, Ali. We have another question come in, and this is, since it has to do with disclosures, I'm going to ask Brian and Alex to handle this one. Okay, June 30th year end shows your loan as debt. What note disclosures are required? Can we say a lot and go from there? But if you want to maybe detail a little bit what some of the disclosures may look like.
And that's a good question also related to the loan accounting for the loan forgiveness and the disclosure. We do have a COVID practice alert specifically address the audit, you know, issue, accounting issue related to the PPP loan. And if this audience, you know, is interested, please reach out to me and I will share with you our practice alert, which including a good disclosure examples for the loans on the book and also the other examples related to the grant model.
Great, thank you, Alex. So, I think we've shot through all our questions. So I will turn it back to Annie, who can close the seminar up for us.
Thank you everybody. With that, we'll conclude our presentation today. Again, be on the lookout for the survey for CPE, and please feel free to reach out to us if you have any follow-up questions.